Hello, everyone. My name is Inam. Happy New Year. And I am probably the newest member or one of the newest members of Charlie's team. I attended our early December session and spoke with Charlie after the meeting. He advised me to look into this topic, the Federal Opportunity Zone, and if I find something interesting or valuable to share with everyone. I spoke with the IRS, the Department of Treasury, a couple of companies that have come out with funds to address this opportunity, a friend of mine who teaches at a fancy school in Boston, and one legal firm that is actually advising the businesses on these matters. Of course, I have not become an expert on this topic and request all to read the disclaimer at the bottom of the screen before proceeding further. Thank you. Okay, before we talk about how many zones, I'm assuming that we all have some basic knowledge and understanding of the topic. Hence, we won't have to share the background, the politics, and the reasoning behind this new program. So, a total of 8,700 new opportunity zones have been created, covering all 50 states, Washington, D.C., and 5 U.S. territories. Puerto Rico being the only one, being the unique one that has 100% of the area being declared as the opportunity zone. Out of 8,700 zones in overall country, 260 are in Georgia. In the past, I think 17, 18 years ago, the state of Georgia also created some opportunity zones. I think a total of 100 such zones were created by the states to offer multiple state level tax incentives. Those zones are totally different, and in most cases, they do not overlap with this new federal opportunity zones. Not linked at all. Uh, and I am working on a chart where I will try my best to show the overlapping of the two categories so that maximum benefits can be obtained in the state of Georgia by the investors if they are in those overlapped areas. And I plan to present that perhaps in my next episode. Thank you. Okay, the characteristics of these zones. The federal government gave a target of 32% poverty rate and having a job loss of at least 6% from 2011 to 2015 as the guide to all the states and territories to identify their own zones. Average national household income turned out to be $59,000 per year, covering about 35 million people in the country, currently residing in these federally identified zones. In some cases, like Louisiana, for example, the average income was around $36,000 per household. Although in New York, the average household income turned out to be in these zones $98,000. Actually, the new Amazon facility that's going into New York, it is also in one of those qualified federal opportunity zones, and apparently the average household income in that given area of New York is above $105,000. Now the basics, and this is an important chart to understand. Uh, Investors can bring their capital gain from any kind of investment and not just the real estate like 1031 exchange. So stocks, bonds, jewelry, art, cryptocurrency, or any other type of capital gain can be invested into these new federal programs. Secondly, a person cannot take his capital gain and invest in these zones directly. Like Mr. Joe Smith buying a property in a qualified zone is not allowed. All investments must go into a corporation or a partnership first, also known as Opportunity Zone Fund, that is either created recently for the purpose of investing in these zones or in existing a corporation or a partnership that modifies its charter and bylaws to state and reflect their new focus being these federal opportunity zones. Lastly, these funds can invest in these zones either in the form of real estate or any other qualified business. These new funds cannot invest any capital and get the benefit into these 8 listed businesses. As you can see, I'm not going to read all. However, restaurants and bars that offer alcohol on their own premises for consumption are okay and qualified. It's just the liquor stores that are not allowed. Besides these 8 listed businesses, every other legal business is qualified. This is also an important chart to understand that the funds can be used for 3 purposes only: either to construct a new real estate facility, or starting a new business, or buying an existing real estate facility or business, provided they substantially improve existing real estate or the business they are buying. The definition of substantial improvement is kind of confusing, and a lot of incorrect information is floating around online. Here's basically what the summary is. If you are buying an existing real estate, running existing that's already constructed, then how the substantial improvement amount will be calculated is as follows. The total value that you used to purchase the property, let's say in this case $1,000,000, the value of land within that value is of $1,000,000 is 400K, then the net real estate value is $600,000. So the substantial improvement becomes 50% of the net real estate value. That's how it will be calculated. But if you're buying an existing business, not a real estate, then the total value of business, let's say, is $1,000,000, then it's simple. 50% of that value that you use to purchase that business will be used as the amount that you have to invest as substantial improvement. How much time do you have to do that? You have 30 months to substantially improve an existing real estate, or construct a new facility, or improve an existing business. Thank you. There are 3 other conditions that we should understand well. Number 1, the minimum 50% sales of business or real estate has to be generated from the zone itself. This has been the most critiqued condition of this plan. The way the policy is written at the moment and released in October of 2018, a business selling items online where more than 50% of its sales will come from other parts of the country outside the zone is not qualified. It is expected that this policy will change when the new details are supposed to emerge in March of 2019. Number 2, 90% of the funds invested has to be in the zones. Basically, that means that the funds are allowed to invest 10% of the amount collected wherever they want to invest outside the zones. Actually, there's a way to bring down that percentage to 70%, and I'll be glad to share that method separately if you have any interest. Lastly, there is no external certification required for establishing such a fund or investing into a qualified investment. It's actually a self-certification process that each fund will have to self-certify with each tax filing, and a new form called Form 8996 has been created by the IRS for this purpose. All right, the zones in our own area. This is not a complete map of Georgia, but only expanded metro Atlanta area. As we can see, some parts of Norcross, Marietta, Smyrna, Ackworth, and Atlanta are also included in it. The new Amazon facility that is going in New York is actually included in a zone. I mentioned that earlier. These zones are not bad zones. I mean, they are very close to very active, commercially active areas, and that's how they have been selected by each state. Okay, the federal capital gain tax benefits. What are the actual benefits? Majority of the experts out there actually believe that the plan has been created in such a way that non-real estate investors, meaning people having capital gains in other areas such as stocks and bonds and all that, it's actually planned for them to bring their money into real estate, which is actually good for people like you and me. Uh, and it appears to be the case so far. There are three things that we really need to understand in terms of the benefits. Number one is that the tax gain deferral is for up to 7 years. Okay, so that's number one, and we'll talk a little bit more about that. There is a partial forgiveness of the capital gain amount to be taxed up to 15%, and we'll talk about that a little bit too. And then forgiveness of additional gains completely, and that's for additional gains for the investment that we are going to make into these zones, not for the investments that we bring into these zones. Okay, we'll talk about all that in a minute. This is a key chart to understand the actual benefits, probably the most important chart of the presentation. Firstly, 180 days. So we all understand that from 1031 exchange that we have after we sell an asset to bring into this program. But in this case, it can be real estate, it can be any other type of capital gain. Number two thing that we need to understand is that the initial benefit, tax deferred benefit that we get uh, is for 5 years. There is no tax. After 5 years, if we decide to pull the money out, the key thing is that if we decide to pull the money out after 5 years, before 7 years, then we will be paying taxes on the 90% of the amount that we actually deposited in these funds. So 10% is waived. But if you decide to keep the money for 7 years, okay, then we pay taxes on 85% of the amount that we brought into these zones, and the waiver is tax-free amount is 15%. There's a key date into this program, which is December 31st, 2026, where all such investments, all such funds will have to open up and declare, and tax will be applied. I think it was done intentionally to motivate people to put money into these funds in 2018 and 2019. So we still have one solid year left to put money into it to get the benefit of these dates. Um, and lastly, any incremental capital gain. The word incremental is the key here. On these investments into these funds, if left untouched for 10 years, will have zero new capital. So if I sell my cryptocurrency for $1 million, and that's my gain, and I bring into these funds, I will and keep it for 10 years. I will pay on $850,000 capital gain tax after 7 years, or 2026, December 31st, whichever comes first. And then let's say that value, and I keep it for 10 years, and the value of that cryptocurrency becomes $2 million after 10 years, then the gain that I experience on my initial investment of $1 million to the tune of another $1 million will not be taxed at all throughout the life of that, and I can enjoy that. Thank you. Here is an example of a fund that was invested, say, in early 2019 or even 2018, and enjoyed 15% tax benefit in 7 years, but kept the money in the same fund for 10 years. Comparing to a standard IRR of 6%, it performed actually 51% better. Not a bad deal. I mentioned this earlier that investing into this fund early is the whole idea. So investing early has significant benefits. As you can see, the incentives perish with delayed investment. Here is another example. This assumes a standard return of 10% per annum. As you can see, your traditional investment will yield a total of 68% after 10 years, but opportunity zones can give you a return of 139%. Again, this is not a comparison with 1031 exchange, but a standard investment since vast majority of funds are expected to come to this project from non-real estate related capital gains. Okay, how much money is out there that can be funneled into these programs? Um, as per all the research articles that I've seen, a total of 6.3 trillion dollars worth of capital gain is out there that is not realized yet. A conservative estimate is that at least 2% of this amount will get transferred into these opportunity zones, out of which at least 80% will be real estate based investments. So we are looking into at an investment of about $100 billion, $101 billion, and at least half of it by 2019 in real estate. Population wise, Georgia is 3% of the country. So if we get at least that much from this total investment, we can probably expect about $3 billion worth of investment into our state in the next 18 months or so. There are many questions out there, and I'm sure I don't have all of them here, but these are my basic 4 questions that I'm not clear about. And you may have come up with your own questions too. As I mentioned earlier, 50% local activity is an issue at the moment. All of my contacts believe that this requirement will be relaxed in March. My other question is that, okay, a fund that takes money and construct a new strip mall, can they lease a shop to a business that is currently classified as unqualified? Like if I have a strip mall, can I have a massage parlor rented out to someone or not? Third question I have is depreciation, bonus depreciation allowed or not? So in the case of when buying an existing real estate that has, for example, a factory equipment, will I be able to bonus depreciate all the equipment in the first year so that I can decrease the net value of my net real estate so that the substantial improvement fund requirement becomes lower? Is that allowed or not? That's not clear at the moment. And lastly, what tax year will be used for tax rate purposes? We are investing money into these funds now, and earliest we take the money out, let's say 5 years, and benefit 10% of waiver. The tax that will be applied on the 90%, will it be the tax rate of capital gain tax rate of that time or today? That is currently not stated in the policy. All that is supposed to come out in March of 2019. The very last chart, what's next? How do we benefit as realtors? What are the real opportunities for us? What tools are out there? There are some states, some cities in the states that are very active in helping out realtors in providing data and access to information and stuff like that. Basically, how can we be on the forefront line of this? This is basically the ongoing research, the next, and I'm continuing with that. If you'd like me to share what I find, shoot me an email or text. I will send you my next presentation. You can call it episode 2 if you want. I don't know when, but I will continue to do research. If I get information or answers earlier than March from the Department of Treasury or IRS, then I will definitely issue earlier. Let's see how it transpires, and then I'm continuing research in terms of real estate side, the realtors benefit side, and what can we do to benefit, and that may be available earlier. So shoot me an email or text or call. I'll put you on the list, and my numbers and the email address is right here, and we'll go from there. Thanks a lot for your time.